While most people were distracted by daily headlines, elections, inflation prints, tech earnings, something structural shifted in the background of the global economy. It did not arrive as a single dramatic event. There was no siren, no crash, no emergency broadcast. Instead, it showed up as a series of temporary trade restrictions, payment frictions, shipping detours, currency settlements outside the dollar system, and bilateral deals that quietly bypassed the frameworks built after 1945. Individually, each move looked manageable. Collectively, they form a single core event. The post-World War II global trade system has begun to fracture. The modern trade order rests on three pillars: predictable shipping routes, enforceable contracts across borders, and a neutral settlement layer, primarily the US dollar, trusted by both sides. When those three align, goods move cheaply, financing is abundant, and inflation stays low. When even one weakens, friction rises. Over the last 24 months, all three have come under stress at once. Shipping costs provide the first signal. The Drewry World Container Index averaged near $1,300 per 40-foot container in 2019. During pandemic disruption, it spiked above $10,000. By mid-2023, it normalized. Then, quietly, it doubled again in key corridors. Red Sea rerouting added 10-14 days to Asia-Europe transit. Insurance premia rose by 30-70% on certain routes. Lead times stretched. None of this makes headlines, but it raises the embedded cost of every physical good. The second signal is settlement. In 2001, roughly 72% of global FX reserves were held in dollars. Today, that figure is closer to 58-60%. That does not mean the dollar is disappearing. It means counterparties are hedging against payment risk. Bilateral trade in local currencies, China-Brazil, Russia-India, Gulf-Asia energy flows, has grown from low single digits to an estimated 10-15% of those corridors. Again, not dramatic. But every percentage point diverted from the core settlement system reduces the efficiency that made global trade cheap. The crowd misses this because markets still look normal. Equity indices hover near highs. GDP prints remain positive. Shelves are stocked. The system appears intact. But this is exactly how structural breaks begin. Not with collapse, but with rising friction that compounds invisibly. The forcing mechanism is geopolitical risk translating into economic constraint. Sanctions, export controls, industrial policy, and security-driven trade rules are no longer exceptional. They are baseline tools. Each one adds compliance cost, delay, and uncertainty. Firms respond rationally. They shorten supply chains, duplicate capacity, hoard inventory, and demand higher margins. Governments respond defensively. They subsidize domestic production, restrict outbound capital, and secure strategic resources. None of this is ideological. It is incentive-driven. What's at stake is not just trade volume. It is the price of stability. The old system allowed a smartphone to cross 12 borders and still cost $800. It allowed a European factory to depend on a single chip plant in Taiwan. It allowed inflation in developed markets to average 2-3% for decades. Break that system, and the hidden tax appears everywhere. Higher input costs, volatile inventories, currency mismatches, and political pressure to choose sides. This analysis is for educational purposes only. It is not financial advice. Economic systems are complex, outcomes are uncertain, and all market activity involves risk. Consult qualified professionals before making any financial or business decisions. Now, here's where it becomes dangerous. History shows that when trade systems fragment faster than institutions can adapt, competition stops being economic and starts becoming strategic. And strategic competition does not stay contained in spreadsheets. Global trade does not move on goodwill. It moves on balance sheets. Every shipment is financed, hedged, insured, and time-matched across currencies and legal systems. The reason a factory in Vietnam can ship shoes to Germany for a few dollars per pair is not because shipping is cheap in a physical sense. It is because the financial layer underneath is extraordinarily efficient. A typical cross-border transaction involves 5 linked components. A producer extends credit by shipping before payment. A bank bridges that gap with trade finance. A currency hedge locks in FX exposure. An insurer covers transit and political risk. A clearing system settles in a trusted unit of account. In 2010, roughly 90% of these steps in major corridors were dollar-based. That matters because the dollar system is deep, liquid, and standardized. A 90-day trade loan in dollars might cost SOFR plus 150 basis points. In local currency, it might be SOFR equivalent plus 400 and 700 basis points, if it exists at all. That spread is not ideology. It is the price of trust and liquidity. Now introduce friction. Suppose a mid-sized electronics importer in Europe buys 50 million of components per quarter from Asia. Under the old system, Yediatri borrows at 6% annualized in dollars, locks FX at a 0.5% hedge cost, pays shipping of $2,000 per container, turns inventory in 45 days. Its annual financing cost on that $200 million flow might be interest, chalk on $12 million FX hedge, $1 million logistics, $4 million total friction, $17 million, or 8.5% of goods value. Now add fragmentation. Dollar financing becomes restricted or politically sensitive. Local currency trade lines cost 10 to 12%. FX hedging becomes illiquid, costing 2 to 3%. Shipping reroutes add $3,000, $4,000 per container. Transit stretches to 65 to 75 days. Recalculate. Interest, $22 to $24 million FX hedge, $4 to $6 million logistics, $8 to $10 million total friction, $34 to $40 million or 17 to 20% of goods value. Nothing breaks. The importer still functions, but its cost structure doubles. That is the mechanism. Fragmentation does not stop trade. It makes trade expensive, slow, and fragile. Every additional compliance rule, payment workaround, or rerouted corridor stacks cost on top of cost. Firms respond rationally. They raise prices, shrink product variety, and hold more inventory. Inventory ties up cash. Cash has an interest rate. At 8-10%, each extra 30 days of inventory adds 0.7-0.8% to end prices. This is why inflation becomes structural rather than cyclical. The second layer is capital efficiency. The old system allowed just-in-time production because risk was pooled globally. A factory in Ohio could run 3 days of inventory because a port in Shanghai, a bank in London, and a clearinghouse in New York formed a continuous trust chain. Break that chain, and just-in-time becomes just-in-case. If a manufacturer increases average inventory from 30 days to 75 days, working capital rises by 150%. For a firm with $500 million in annual cost of goods sold, that is an additional $60 million tied up. At a 9% cost of capital, that is $5.4 million per year in deadweight expense. Multiply that across thousands of firms. This is the part most people miss. Fragmentation is a balance sheet shock disguised as a political story. The third layer is feedback. As costs rise, firms push for subsidies and tariffs. Governments respond with industrial policy. Trading partners retaliate, compliance expands, banks tighten risk limits. Financing costs rise further. Each step is rational in isolation. Together, they form a closed loop of rising friction. Markets often misread this phase because volumes do not immediately collapse. Global trade in goods peaked around $25 trillion in 2022 and still hovers in the low $20 trillion. That looks stable. But stability in volume with rising cost means margin compression somewhere in the system. Either producers earn less, consumers pay more, or states subsidize the gap. Usually all three happen. The system worked because it minimized the number of times capital had to think about borders. The new system forces capital to evaluate politics at every step. That is not slower by 5%. It is slower by a regime change. And once trade becomes a strategic asset rather than an economic one, the price is no longer set by efficiency. It is set by security. Fragmentation does not hurt everyone equally. It concentrates stress on the actors who operate on thin margins, tight timelines, and borrowed capital. These are the nodes that made globalization efficient, and now make it fragile. Start with manufacturers. Modern production chains were engineered for speed, not redundancy. A car assembled in Mexico may rely on semiconductors from Taiwan, sensors from Germany, resins from South Korea, and machine tools from Japan. Margins in many industrial sectors sit between 5% and 12%. When financing, logistics, and compliance costs rise by even 3 to 4 percentage points, profit is not reduced. It is erased. These firms face a binary choice: either raise prices and risk demand destruction, or absorb the cost and weaken their balance sheets. In competitive export markets, price increases are often impossible. That pushes companies toward leverage. Short-term credit lines, supplier financing, and inventory loans expand. The system becomes more debt-dependent precisely as capital becomes more selective. Banks are the next pressure point. Trade finance is low margin, but high volume. It works because default risk is diversified and political risk is minimal. As corridors become politicized, banks must assign sovereign risk to ordinary shipments. A container of copper wire now carries the same compliance burden as a bond issued by the exporting country. This forces banks into their own binary choice: either withdraw from gray corridors or raise margins and collateral requirements. Most choose both. The result is uneven liquidity. A firm in a favored jurisdiction borrows at 6 to 7%. An identical firm in a sanctioned adjacent region borrows at 12 to 15% or not at all. Funds and market makers are trapped differently. Many strategies assume stable cross-border arbitrage, buying in one market, selling in another, capturing basis points at scale. When settlement becomes uncertain, these trades carry tail risk. A one-day payment delay at scale can trigger margin calls. A 5% currency swing can wipe out a year of carry, so capital pulls back. Liquidity thins, spreads widen. Now look at governments. Export-dependent states, Germany, South Korea, Taiwan, Vietnam, built their social contracts on trade surpluses. If export growth slows from 6% to 1%, tax receipts fall while social obligations remain fixed. Debt to GDP ratios rise mechanically. Fiscal space shrinks. Import-dependent states face a different trap. They must secure energy, food, and inputs in a world where suppliers increasingly demand political alignment. The choice becomes accept higher cost and dependence or subsidize domestic production at enormous expense. The United States CHIPS Act commits over $50 billion to semiconductor fabrication. Europe's industrial subsidies are measured in the hundreds of billions of euros. These are not growth investments. They are insurance premiums. Households are the silent pressure point. For 30 years, real goods prices fell or stagnated. A television that cost $1,000 in 1995 costs $400 today in real terms. Apparel, appliances, and electronics followed the same path. That deflation was the dividend of globalization. Fragmentation reverses it. A 2 to 3% annual increase in tradable goods prices compounds quickly. Over a decade, that is 22-34%. Wages rarely match that pace. Political pressure builds. Voters demand protection. Protection accelerates fragmentation. This creates the central trap. Either states preserve open trade and accept strategic vulnerability, or they harden supply chains and accept higher inflation and lower growth. There is no free third option. History offers a parallel. The 1930s. After the 1929 crash, countries raised tariffs to protect domestic industry. U.S. trade fell by roughly 65% between 1929 and 1934. Britain formed imperial preference zones. Germany pursued autarky. Japan sought resource security in Asia. Each move was defensive. Together, they collapsed global volume and aligned economies into rival blocs. The difference today is scale and interdependence. In 1930, global trade was roughly 9% of world GDP. Today, it is closer to 45-50% when goods and services are combined. Supply chains are not just longer, they are structurally entangled. You cannot unwind them without breaking something. That is why this phase feels stable until it isn't. Pressure accumulates in margins, in credit lines, in inventories, in budgets. Then one node fails. A bank pulls a corridor, a port closes, a currency gaps, and everyone realizes how little slack remains. To understand why this shift is not cosmetic, you have to look at the system the way a logistics officer or a bank risk manager does, as a set of flows that must remain synchronized. Global trade works only if goods, capital, and currency arrive at roughly the same time. Break that synchronization, and cost does not rise linearly. It jumps. Start with inventories. In the 1990s, U.S. manufacturers held roughly 70-80 days of inventory on average. By 2019, that figure had fallen to around 45 days. Retailers fell even further, in some categories operating on 25 to 30 days. This was not recklessness, it was rational optimization under a stable system. Each 10-day reduction in inventory frees roughly 2.7% of annual revenue in cash. Across a $20 trillion goods economy, that is hundreds of billions in working capital. Fragmentation reverses this. If firms move from 45 days back to even 65 days, a modest buffer in historical terms, that is a 44% increase in inventory. For a mid-sized industrial firm with $1 billion in annual cost of goods sold, 45 days, you 123 million tied up. 65 days, you 178 million tied up. Delta, 55 million. At a 9% weighted cost of capital, that is 5 million per year in additional carrying cost. Multiply this across 50,000 manufacturing and distribution firms globally. Even conservatively, the system absorbs $200-300 billion per year in new deadweight expense. That is not growth. It is friction. Now look at trade finance. The Bank for International Settlements estimates global trade finance at roughly 10-12 trillion outstanding at any time. Margins historically run between 100 and 200 basis points over funding cost. If geopolitical risk and corridor fragmentation add even 150 basis points to average spreads, that is 10 trillion DAX, 1.5%, $150 billion per year. Again, this is not a one-time shock. It is a permanent tax embedded in every shipment. Next, currency. Roughly $7.5 trillion in FX trades clear daily. About 88 to 90% of those involve the dollar on one side. That dominance is not political, it is mechanical. It minimizes basis risk. Every time a trade bypasses that hub, it introduces an extra conversion. A China-Brazil trade settled in yuan and reais instead of dollars requires yuan, real hedging, two shallow liquidity pools, wider bid-ask spreads, longer settlement windows. If the effective FX cost rises from 0.2% to 1.2% on a $100 million flow, that is $1 million in added friction. On corridors moving $300, $400 billion per year, that is $5 billion annually per corridor. Now scale this. Scenario A, mild fragmentation. 10% of global trade rerouted through higher cost corridors. Average friction increase, 3% on $25 trillion in goods trade. Affected volume, $2.5 trillion. Added cost, $75 billion per year. Scenario B, moderate block formation. 25% of trade subject to dual systems. Friction increase, 5 to 7%. Affected volume, $6 trillion added cost. $420 billion per year. Scenario C, hard fragmentation. 40% of trade aligned into competing blocks. Friction increase, 8 to 12% affected volume. $10 trillion added cost. $800 billion, $1.2 trillion per year. These are not crash numbers. They are slow burn numbers. They show up as 0.5, 1.0%, lower global growth, 1 to 2% higher structural inflation in tradable goods. Persistent fiscal pressure as states subsidize inefficiency, balance sheets absorb this until they cannot. Corporate debt globally sits around $90, $100 trillion. Much of it was issued in a low-rate, high-efficiency world. Refinancing that debt in a higher friction system changes viability math. A firm earning 8% operating margin that sees costs rise by 3% does not lose 3%. It loses 37.5% of profit. If it was levered at 4x EBITDA, its interest coverage can collapse from 4.0x to 2.5x without any drop in revenue. That is how trade friction becomes a credit event. The reason normal expectations fail is that the old model assumed scale would always reduce cost. The new model rewards redundancy, alignment, and security. Those attributes do not scale cheaply, they scale politically. The data does not predict a single outcome. It shows a boundary condition. A system optimized for zero friction cannot absorb permanent friction without repricing everything built on it. Markets do not react to structural change in a straight line. They oscillate between denial and overreaction. In the early phase of fragmentation, prices often rally. Equity markets interpret state intervention as stimulus. Defense, infrastructure, and industrial stocks surge. Commodities lift on reshoring demand. Volatility compresses because policy appears supportive. This is the misread. What the market initially prices is activity, not efficiency. A $50 billion semiconductor subsidy looks like growth. A $200 billion industrial policy package looks expansionary. But subsidies do not create surplus. They reallocate cost. They convert private inefficiency into public debt. The transmission usually follows a familiar pattern. Cost shock, shipping rates rise. FX hedging widens. Trade finance margins increase. Corporate guidance quietly deteriorates. Gross margins compress by 50, 150 basis points across goods sectors. Earnings divergence. Firms with domestic supply chains outperform. Multinationals underperform. Correlations that once held global growth equals global equity strength begin to break. Credit repricing. Bond markets react before equities. Credit spreads widen, first in export-heavy industries, then in banks with trade exposure. A move from 120 to 200 basis points in investment-grade spreads adds 0.8% to corporate funding cost. On $10 trillion in rolling maturities, that is $80 billion in annual interest. Liquidity retreat market makers widen bid-ask spreads. FX liquidity thins in non-core pairs. Basis trades become volatile. Carry strategies unwind. What looked like a microstructure issue becomes a macro signal. Policy feedback governments respond with more protection, more subsidy, more capital controls. Each intervention stabilizes a node and destabilizes the network. The visible market symptoms tend to be sudden gaps in freight and commodity futures, persistent backwardation in secure resources, regional equity divergence, rising cross-currency basis, volatility spikes without obvious news, credit spreads, leading equity drawdowns. Observers often describe this phase as irrational. Why are markets selling when GDP is positive? Why is volatility rising without a recession? The answer is structural. The market is repricing how growth is produced, not whether growth exists. When efficiency falls, the same nominal output requires more capital, more energy, and more debt. That lowers return on capital. Equity valuations are functions of expected return divided by risk. If expected return falls from 8% to 6% while risk rises, fair multiples compress, even if revenue grows. This creates the core feedback loop. Fragmentation raises cost, cost compresses margins, margin compression weakens credit, credit tightening raises financing cost raises price. Price triggers political intervention, intervention deepens fragmentation. Markets express this through volatility and correlation breaks. Traditional hedges fail. Bonds do not rally when stocks fall because inflation risk persists. Commodities rally during growth slowdowns because supply is constrained. Currency moves are driven by payment reliability rather than yield. What to watch is not headlines, but structure. Trade-weighted dollar versus cross-currency basis, investment-grade and high-yield spreads. Shipping indices versus producer price indices. Inventory-to-sales ratios. Freight futures curves. FX reserve composition shifts. ETF flows into strategic sectors. These indicators tell you where friction is becoming permanent. The reaction often feels chaotic because markets were built on the assumption that borders were operational details, not risk factors. Once borders become financial variables, every model changes. Structural shifts rarely announce themselves with a single event. They reveal themselves through sequence. The next phase of this transition will not look like a crisis in the classic sense. It will look like a series of mismatches between prices and availability, between policy intent and market response, between political timelines and balance sheet realities. The timeline usually unfolds in layers, next 24-72 hours. Markets respond to surface signals. A shipping disruption, a sanctions update, a central bank speech. Volatility flares in FX and commodities first. Equity markets often shrug, credit quietly widens. These are micro adjustments, not regime calls. Next 1 to 4 weeks, earnings guidance begins to diverge. Multinationals cite logistics, currency, and compliance. Freight curves steepen. FX basis moves become persistent. Analysts downgrade margin assumptions by 50-100 basis points. Still no panic, just revisions. Next 1 to 2 quarters. Refinancing windows arrive. Subsidies meet budget ceilings. Trade volumes flatten while nominal values rise. Inflation decouples from growth. Policymakers face an uncomfortable reality. Easing stimulates prices. Tightening deepens strategic vulnerability. From here, 3 broad scenarios emerge. 1. Base case. Manage fragmentation. This is the most likely path. Trade volumes remain broadly stable. Costs rise 3 to 5% in strategic sectors. States subsidize gaps. Inflation in tradable goods runs 1.5% above pre-2020 norms. Growth slows by 0.5 to 1.0% globally. The system does not break, it becomes heavier. Confirming indicators. Credit spreads widen modestly but remain orderly. IG 140, 180 BPS. Shipping indices stabilize at elevated levels. FX reserve diversification continues gradually. Industrial subsidies expand without emergency measures. Corporate margins compress, but remain positive. This is a world of lower returns and higher volatility, not collapse. 2. Stress case. Financialization of geopolitics. Here, a shock exposes the lack of slack. A major corridor closes or becomes non-insurable. A payment system is disrupted. A large exporter or bank faces a liquidity event tied to trade finance. Capital reacts faster than policy. Outcomes. Credit spreads gap wider. IG 250 BPS, HY 600 BPS. FX pairs experience disorderly moves. Commodity markets enter persistent backwardation. States impose capital controls or emergency trade rules. Growth contracts in trade-dependent regions. This is not a 2008-style banking collapse. It is a network shock. The system still exists, but trust between nodes disappears. Confirming indicators. Sudden withdrawal of trade lines by major banks. Cross-currency basis spikes. Insurance withdrawal from shipping lanes, emergency trade, or currency measures. Volatility in multiple asset classes simultaneously. 3. Relief case recoordination. This requires political alignment. Major blocs agree on trade firewalls rather than fragmentation. Payment corridors are stabilized. Industrial policy becomes complementary rather than duplicative. Security concerns are ring-fenced. This does not restore the old system, but it caps friction. Outcomes. Freight and FX costs normalize. Inventory ratios stabilize. Credit spreads compress. Growth recovers modestly. Confirming indicators. Multilateral trade agreements resume cross-border investment treaties, expand, FX reserve diversification slows. Shipping insurance costs fall. Corporate guidance stabilizes. This is possible, but historically rare during periods of power transition. The deeper takeaway is this. Markets were built to price risk inside a stable architecture. That architecture is changing. What looks like geopolitics is actually balance sheet physics asserting itself across borders. The old system optimized for efficiency. The new system optimizes for resilience. Resilience is expensive. It lowers returns, raises prices, and rewards alignment over scale. That is not a temporary cycle. It is a regime. This analysis is for educational purposes only. It is not financial advice. Economic outcomes are uncertain. Markets involve risk, and no single framework can predict complex systems. Consult qualified professionals before making any financial or strategic decisions. Understanding this shift is not about forecasting a single event. It is about recognizing that the rules under which the last 30 years were priced no longer hold. The map has changed. The terrain is heavier, and systems built for frictionless motion do not adapt without stress. Stay analytical. Watch structure, not headlines. And remember, markets do not fail because people panic. They fail because systems run out of slack.